Every day, billions of dollars move through the stock market. People are excited when prices rise and nervous when prices fall. But what is actually happening behind those numbers on a screen? The stock market often seems mysterious. But here's a simple truth. It's just people buying and selling small pieces of businesses. By the end of this video, you'll understand how the stock market works, from how companies raise money to how stock prices change. First, let's look at what a stock is. A stock represents a small ownership interest in a company. Think of a growing pizza business. If it needs money to expand, it divides ownership into many slices. Each slice or share makes you a partial owner. But owning a piece doesn't mean you control every slice. It gives you ownership rights depending on the share type. Now, why do companies sell shares? Businesses need money to grow. They may want to build new facilities or hire employees. Selling shares is a way to raise money from investors. This brings us to the concept of being publicly traded. An initial public offering, or IPO, allows companies to offer ownership shares to the public for the first time. Next up, what is the stock market? It's not just one building where everyone gathers. The stock market is a system of exchanges where buyers and sellers trade shares. Stock exchanges provide organized marketplaces. Brokers and investment platforms help you place buy and sell orders easily. But why do stock prices go up and down? It's all about supply and demand. If more people want to buy a stock than sell it, prices rise. If more people want to sell, prices fall. Investor expectations play a key role. Company performance, economic conditions, and industry changes influence how stocks are valued. Sometimes, stock prices change due to emotions, not just company performance. How do investors make money from stocks? There are two ways: capital appreciation and dividends. Capital appreciation is when stock value increases after you buy it. Dividends are payments some companies choose to give shareholders. Remember, there are no guarantees with stock prices or dividends. Stocks can lose value too. So, what happens when you buy a stock? When you buy a share, you're using a brokerage account. You place an order that matches you with a seller in the market. You might encounter a market order or a limit order. Most trading is about buyers and sellers exchanging shares, not sending money directly to the company. Investing differs from trading. Long-term investors focus on a company's fundamentals, while traders react to short-term price movements. Neither approach guarantees profits. Beginners should prioritize education and define their long-term financial goals. Understanding risk and diversification is crucial. The stock market can build wealth over time, but it involves risk. Prices may fall, and companies vary in performance. Diversification means spreading investments across different companies. However, this doesn't eliminate risk. Developing a financial plan is important. Let's tackle common myths about the stock market. Some think it's only for the rich, but it's more accessible now. You don't need to be a financial genius to invest. Basic financial knowledge helps. Many believe you can get rich quickly, but stock markets involve uncertainty. It's important not to panic during market downturns. In conclusion, remember the stock market is a marketplace where business ownership is bought and sold. Each ticker symbol represents a real company trying to grow. Understanding the basics changes your perspective. A stock isn't just a number. It represents ownership and the story of a business. Let's continue learning before investing. Understand your financial goals, and avoid decisions based on hype. What stock market concept surprised you? Comment below, like this video, and subscribe to Finance Flow for more engaging content about money and investing. Every share of a company is a reflection of its story, serving as a window into its potential for growth or decline. As you continue to explore these concepts, consider how different factors, like consumer demand or technological advancements, impact a company's performance and, consequently, its stock price. For instance, if a pizza business starts introducing innovative toppings that attract customers, it could lead to an increase in revenue, thereby boosting investor confidence. Next, let's explore the significance of market sentiment. Investors' feelings and perceptions about a company or the economy can greatly influence stock prices. If the public feels optimistic about a company's future, they are more likely to buy shares, driving up demand. This enthusiasm can stem from positive news like earnings beats or product launches. Conversely, negative news, such as financial struggles or management scandals, can trigger fear and lead to a mass sell-off. Understanding this psychological aspect is crucial for any investor hoping to navigate the often tumultuous waters of the stock market. As we explore further, it's essential to recognize the role of market analysts and financial news. These experts and platforms provide insights, predictions, and analyses, shaping public perception of stocks. When an analyst issues a buy rating on a company, it can spark excitement among investors, prompting increased purchasing and pushing prices higher. On the flip side, a sell recommendation can have the opposite effect, creating fear and urgency to offload shares. This interplay between expert opinions and public sentiment can lead to rapid price fluctuations, illustrating the importance of staying informed and discerning in your investment decisions. Always remember, education is key to understanding and mastering the stock market dynamics. As you delve deeper into stock market intricacies, it's beneficial to comprehend various investment strategies. For instance, value investing focuses on identifying undervalued stocks that have the potential for long-term growth. Investors employing this strategy conduct comprehensive analyses to find stocks trading below their intrinsic value, hoping the market will eventually recognize their true worth. Conversely, growth investing hones in on companies expected to grow at an above-average rate compared to others, prioritizing earnings potential over current valuation. By understanding these strategies, you can better align your investment choices with your financial goals and risk tolerance, enhancing your market approach. As you develop your investment strategy, it's also important to create a diversified portfolio. This means holding a mix of different types of stocks and other assets, which can help mitigate risk. For example, investing in various sectors like technology, healthcare, and consumer goods can protect you from losses in any single area. Additionally, consider incorporating bonds or mutual funds, allowing your investments to weather different market climates. By spreading your investments wisely, you position yourself for potential growth while safeguarding against market volatility. Ultimately, informed and strategic investing leads to more sustainable wealth over time. As you consider your investment approach, it's vital to assess your personal risk tolerance. Risk tolerance refers to how much loss you can bear while investing. It can vary from person to person, influenced by factors like age, financial situation, and investment goals. Younger investors may take on more risk since they have time to recover from potential losses, while older investors often prefer more stable investments to preserve their capital. Recognizing your risk appetite will enable you to make decisions that align with your long-term financial strategies and ensure you're not overly stressed by market fluctuations. As you venture into the world of investing, it's equally important to establish a clear exit strategy. An exit strategy outlines when and how you'll sell your investments, ensuring you can lock in profits or minimize losses. Whether you decide to set specific price targets or monitor key indicators that signal a change in your stock's performance, having this plan can provide peace of mind amidst the ever-shifting market landscape. Remember, being proactive about your investments can help you stay focused and disciplined, significantly impacting your overall financial success over time. While all these elements contribute to effective investing, let's not overlook the importance of staying updated on economic indicators. Factors like interest rates, inflation, and unemployment can affect market conditions and influence investor behavior. For example, rising interest rates might make borrowing more expensive, leading businesses to slow their growth, which could depress stock prices across the board. On the other hand, a robust economy with low unemployment can encourage consumer spending, benefiting companies and, in turn, their stock values. By regularly reviewing economic data, you empower yourself to make informed investment choices, adapting your strategy as necessary. As the market continually shifts, it's essential for investors to remain resilient and adaptable. One crucial lesson is to develop patience. The stock market is rarely a straight path to success. Investments may require time before yielding significant returns, emphasizing the value of a long-term perspective. By maintaining a steady hand, you can navigate downturns without making impulsive decisions that could harm your financial future. After all, consistent education and a calm approach will help you thrive in the dynamic world of investing. In conclusion, as you embark on your investment journey, remember that knowledge and strategy are your best allies in navigating the complexities of the stock market. Each decision shapes your financial future, and understanding the intricacies involved can empower you to make informed choices. Stay curious and engaged, and let your investment story unfold.